What's up, guys? Here with another video showing you how to get a yield. We know the bull market's been a little crazy, but we always say you want to have a certain percentage of your bag in stables. You never want to be all in. I made that mistake last bull market. So today we're going to be talking about a hot new protocol called Ethena Finance. And we're just going to go through everything, talk about some strategies, talk about some opportunities, talk about some things to think about. We got my brother Chris on the line, straight from Africa. It's 11:11 p.m. Make a wish. Chris, how you doing, man?
I'm doing great, guys. I'm doing great. It's fun to be here. Let's say that. It's fun to be here right now. So yeah, cool. So we can hop into it. I will start with a quick overview of like Ethena, and then we can go over to carry trade. So recently, bull markets happened, et cetera. This cool protocol popped up called Ethena.fi, and they are basically tokenizing a carry trade. And we'll go over what carry trade is later. With you either can purchase their token, which is a bond, they call it a bond insurance token, or you can mint new tokens similar to what you do with MakerDAO, or even like Rhapsody and USD to actually access their collateralized token or their tokenized carry trade. They're saying the yield is, I think it's as of today, like 33% on
That's
the
what
token.
I saw too. Yeah,
and it feels very like Wayback Titan or Lunaterra kind of energy. It's different, but it's still close. So I actually haven't really been using it. I've just been executing the carry trade, and I'll tell you why afterwards. But let's go with what is a carry trade, and then we'll go over like how their mechanism works.
sounds good.
So carry trade is we'll just use BTC. BTC is, we'll say it's $50,000. You buy one BTC, amazing. Then you take at the same time a short position. In this case, most people are using a perpetual futures contract, and you take a short at the same time on there at the $50,000.
So basically, I think a lot of people will be wondering this too. How is that yield generated for the shorts? So how can they such an API? And how do they determine what the funding rate is at any given time?
So the funding rate is different amongst all different perps exchanges. It's a little bit of, I'm not gonna say secret sauce, but the on-chain ones you can calculate it. They have most of them have either on-chain calculations, or they have documentation showing how they're roughly calculating the funding rate. Simple answer is supply and demand between people taking a long position, people taking a short position. In crypto specifically, this is data that I double checked with Ethena, but Ethena did all the work. I think we've had like 15 to 20 negative funding rate days, which means the short side would be over the past 3 years would be having to pay for that position. So if you want to take leverage, if you want to take whether you're going long or short, you have to pay for that. You always have to pay for leverage, basically. And so that funding rate is the payment that one side is giving to the protocol. In this case, then they divvy that up between the short side, and then a little protocol takes a little bit.
I wrap that up and say, ideally for a platform like this, it's always better to just have obviously more longs than shorts at any given time on the platform.
I wouldn't say it's better or worse. I say the platform is agnostic. They just want you to trade. So the thing is, we're looking for us, we're taking a trade on. Like I'm taking a trade on myself personally. I'm not using Ethena. And it's not financial advice. The big thing is like looking at historical data. Yeah, I have to say it a lot now. Looking at historical data.
Yeah. So yeah, not advice, none of it, guys. My bad.
Yeah, so the big thing I like about Ethena, and I've seen this trade before, but it wasn't as lucrative. Usually it's like 15%. I think even like in the 2020, it was like 16, 17% for the annualized, the actual year, it was 16%. 2021, the bear market begins, it was 0.7% return. And then like one more year after that was like 6% or something like that. 2022 was 6%. So right now it's like a very lucrative time to actually put this trade on, because usually not everyone does it. But in general, the exchange doesn't care what side has more volume. So they don't care if the longs have more volume or the puts have more volume. But if in the case it was reversed, so you needed to short, well, I'm not gonna go through that trade, it's actually really hard to do in crypto. But if there was more shorts than longs, the long side would be paid out for providing that trade, because they're probably losing at that point for providing that leverage for the other side.
So quick question. So I see on the website you get the 33%. That's just from holding the stable coin, right? Okay.
Yeah.
Now In terms of like taking the long side or on the short side, maybe it'd be helpful to compare it to GMX. So I know by holding GLP, you're essentially providing liquidity for people who are taking leverage. And if historically, the reason why it's a good trade or a good way to generate yield is because historically leverage traders lose on average. So you make money when leverage longs or when leverage shorts like under or overperform. So in this case, how can you take a position on a long or short side, excluding just holding the token?
Can you? I don't understand exactly what you're asking right there, because I understand the GLP part, but like the Ethena part,
That's basically like, because you were saying like the shorts are getting paid, like I think you said 60 to 70 to 80. Are they just shorting? Like, how are they making that money? Taking this, like, can you explain that part?
Oh, okay. So we'll use Ethena. So Ethena, you have to be a like KYC or like a market maker to actually mint their token. They're like the actual collateralized position. Provide wrap staked ETH, which has on average like 4 to 5% yield, and then they would be minted out the USD bond that they give them, like, which is representative of that API, the return. At the same time they mint that, they work with third parties to take a short position on centralized exchanges. They prefer centralized exchanges. That's one of the other reasons I don't love them. They're like semi-decentralized. And then at that point, they have wrap stake ETH. They have a short position on ETH at the same time. They don't care now what the actual price of ETH does at that moment, because if they lose it, say ETH goes down $1,000, which makes this wrap stake ETH a lot less, they've now earned $1,000 or so on the short position. At the same time, they're also going to be getting a funding rate on that from the centralized exchange for providing that position, because people still are most of the time long on these exchanges. So that funding rate is coming. That APY is coming from the funding rate. It's I've been following it for 2 weeks, 3 weeks, something like that now. It varies. They started out at 40%, which was insane. And that was a red flag, and it came down to like 25%, and then it's now back up to 30. So it fluctuates at every given week. It's like an FX cycle, but they're getting most of the yield is coming from that short position on the centralized exchange for providing a win or collateral to the long side, because long has been winning this whole entire time, and they're paying for that leverage that they have at that point. So
man, it's so crazy, because it kind of just seems like the entire protocol is based on arbitrage in pretty much every part of the system, literally.
yeah, yes, their whole entire, like this trade, there's a couple others that's trying to do it, and there's one or two that did it a while ago. It's all about arbitrage. Like, this is an arbitrage play right here. This arbitrage is huge right now, and because it's one of the most volatile times we've had in 3-4 years now. But in history, as you look over all the funding rates, it should come back down to like 5 to 15% at that point. And they're getting a little bit of bump because they're using wrap stake ETH. You can there's some trades on DeFi Llama I can show you guys. So this is a little bit different version. I think I haven't used DForce or exactly. I have used Extra Finance, which is a lending platform where you can, a lot of people use it to short various tokens on Optimism. But the same concept applies. Pretty sure DForce is a perpetual platform, and in this case you're going to take your long position there, and then you're going to short it on Extra Finance. But it's the same arbitrage concept where you have a higher yield from the Extra Finance versus basically selling a long position on DForce, and you're going to potentially lose money, make money. You're not sure on that, but the neutral, that nullified out, and all you really care about is that APY that you're making from Extra Finance in this case. So that's the lending yield. But I'm going to go to Arbitrum, and I think they have what I want. This one right here. This is on mainnet, but this is like literally the same trade that Ethena Fi is doing. You buy wrap stake ETH, and then you take out a short position on synthetics, and then you're earning. This is let me see if I get a breakdown today. Oh, here we go. Cool. So you have the farming APY, which is 4.13 from wrap stake ETH. You have the funding rate, which is averaging out on synthetics to be every 8 hours, 143% annualized. And then you can look at what it would be if you keep compounding in the same position at that point. So yeah, it's kind of insane. This funding rate, I think synthetics pays every 2 hours.
So these guys are earning 143% every 2 hours, the short positions?
On synthetics, yeah. Synthetics.
On synthetics, okay.
Yes, you got to make sure, because everyone's different. And so also because of that, synthetics I don't think has portfolio margin, so you have to be collateralized like 1-to-1. Do you guys talk about leverage? Is leverage allowed? That's my first question.
Yeah, of course.
Yeah, okay, cool.
So we can say anything.
Oh, perfect. It's not financial advice. If you want to be, you can get liquidated doing this if you don't do a 1-to-1 position. If you want to be collateral efficient, but like some of the other platforms that are not synthetics allow portfolio margins, so you can use positions you already have outstanding and they can count those as like your collateral as well. So you can, for instance, on one ETH, on like I think like AVO, you probably put like 4 or 5 contracts on that one ETH at that point. I don't remember how many off the top of my head, but you can like load up a ton of contracts, even at 1%, 1x leverage, which is just a 1, because they count those contracts as your collateral as well. So you can really be much more capital efficient, but you have to worry about being liquidated if you do that. So that's the unfortunate moment if you do use margin into its fullest. But yeah, it's you can make a lot. This is even more than it was the other day. I actually don't like synthetics because it's capital inefficient. It's like just clunky to me. So they're launching a new one soon. Hopefully that'll be better. But it's the highest. So it's always been the highest. It's the most inefficient market perps market out there.
Are you doing any of these strategies?
Yes, I'm doing this. Yeah, I'm doing this Pendle strategy where you can buy a Pendle's.
Pendle's been ripping.
Oh, I don't have the funny thing. I did not buy any of the token. I don't have any of the, I don't have no. I don't have any exposure to Pendle.
I bought the lows. We made a video on it back in November. It's actually like my largest position.
You know, that's when before I started watching your videos, and I'm very sad for myself on that one. Let's do this. Okay.
Oh, good.
So yeah, no, because I had a friend who was telling me about it back then too, around the same time. And I just didn't execute, and like it ripped, and it's I'm probably still ripping right now because this is what trade everyone's making right now. They're either trading into various wrap staked ETH stuff, like your staked ETH things, and hedging themselves out, or they're doing this carry trade, which is boosting your yield by a lot. So you get our staked ETH, silo ETH, kind of crappy for this situation. It's normal, or EETH, and then you can go, and then that's 40% yield that you're or annualized APY, whatever. Annualized APY that you'd be getting over the course of like 56 days or something, and then you just take a short position at the same time on your favorite perps exchange, and you get to reap the funding rate on that short position plus whatever you're getting from Pendle. So you see like farming APY from Pendle, 34%, 34.91, which was the so the RS ETH that doesn't, or ETH, either or. And then you take out a short position. This one says synthetics. I use AVO, but same concept. You're going to earn that 143% as well, and so it compounds. It's like it's a very nice yield right there on ETH.
I was going to ask. Okay, so I'm assuming you're doing this obviously with the fact that we're going into I'm not going to say going into we've been in a bull market and we think it's going to continue. What strategy would you employ on this if you thought we were going to be expecting some downside? Like, what's like a good bear market strategy, I guess?
I think this is a great bear market strategy right here. Like this is probably, if you're worried, like, oh, I made, if you're not long ETH, so like before I was generalized long ETH. I didn't have a short position on my ETH. I was just like dollar cost averaging into ETH all the time. And I wasn't taking any hedge on downside protection. And so this is a time where it's like, oh, I've made some amount of dollars. Say you made $1,000 and you want to maintain your $1,000 and earn some more. This is a strategy where it's like you can lock in your USD value, and then you can start to earn more on that without having to worry about the volatility of Ethereum, but you want to maintain exposure to Ethereum at this point because the yields are pretty darn nice to be an ETH yield. So there's a risk involved, but it's still a very nice yield for the risk reward. So yeah, this would be a bear market strategy more so than a bull market strategy. I've actually started deploying this more solely because I wanted to, one, understand it, and two, if there is a pullback. It's been a very nice fluid trend up over the past 3 weeks to basically like 2 months. But at some point you gotta have a little pullback. I'm just hanging out with that. I don't have all my stack in this by any means, but it is a nice protection to lock in a USD value like.
For sure. So do you think this model that they have is sustainable? Like I was reading that they have like an 8-figure treasure or insurance.
Oh, let's see if it's still. Yeah, so I don't like their model for Ethena. I'm gonna say that. Yeah.
You know, we all see what happened with Terra. We've seen stable coins depeg a lot. Like, how do you think about this protocol? Because this is like somewhat new, just a different twist.
Yeah.
Obviously, they have like some of the best backers in crypto. Like everyone's backing this project. So I guess it's like, what's your thoughts on this project moving forward?
I'm not as worried as like Terra, because they're not trying to. They're not making their own chain. They're not making like their own ecosystem. They're not. They may, but they're not right now deeply integrated into the VC startup culture. One of the biggest things about Terra Luna that made it really bad was it was at a point in the cycle where they brought normies in, and normies were like, I can earn 20% on a US dollar. And that's great. That's awesome. That was like sustainable, but it was not. And there was a lot of VC money backing that. There was a lot of like infrastructure that was created because of that VC money backing it. And there's still VC money backing Ethena, but it's almost all crypto native. And then also they're trying to do things that are not Terra Luna like. So I do like that about it. I also am a big, I like Dragonfly Capital. Most of their investments are been really good, or high like noise to what is the ratio? What's I just forgot that saying, but whatever. They've been good investments. They've been overall like good projects, good teams, except even if they fail, they do good stuff. And so I actually follow a lot of the projects. So that's really cool, that being one of their #1 investors. So like, I don't think you're gonna get rugged. I don't think anything bad's gonna overall happen with the code. I think they take a lot of time to make sure it's safe stuff. But I don't like how they do insurance. If that makes,
What don't you like about the insurance?
So the people, the market makers and the KYC people that get to mint the actual collateralized position, the USDE, they are not on the hook if there's a downside event. So basically, they say that if it's not a stable coin, but they kind of infer it's like a stable coin. If it loses peg, or it loses what the actual value should be, net value should be after, like, it's earned so much percentage, it should be a little bit above 1. Great. If that starts to drop to like 90 cents on the dollar or something like that, they assume people will arbitrage, or they have agreements with market makers that arbitrage will happen, where they'll burn the USDE. They'll then take out the wrap stake ETH and like sell it and all that good jazz. They'll make it so it should come back to balance. You just don't know how that's going to work out, because you can't. The normal person can't do it. It has to be a market maker. It has to be KYC individuals. So it's like, or high net worth individuals. So hopefully they do it, because there's money to be had, but you don't know. And then 2, you have another moment where they have third parties. They're not the exchange this time, which is good. It's not FTX or the equivalent of like an FTX or Binance, but they have third parties that are executing the short position, and that's okay, but you still have third party risk again, where you can't see, like, they haven't made it public what their positions are. They say they're 1-to-1, but I'm like 95% sure that the market makers who are working with them are doing maybe not high leverage, but they have to be putting on some leverage. It's just like they're going to put on leverage. That's what market makers are going to do. They're trying to squeeze out every bit of energy, every bit of the yield they can. And so, like, it's just like all these little conundrums of like, if things go wrong, they have $10 million they say that they'll provide for insurance, but they're at like, I don't know, 800 million total assets under management. So like, that's almost like 10%. It's a little over 10% of their total outstanding value. So it's like, that's going to do nothing overall for the majority. It's going to be like a drop in the bucket of like trying to save something. So like, if anything goes wrong, it's going all the way south, in my opinion. That $10 million means nothing with how much TVL and volume and just stuff around the ecosystem. It's going to mean nothing. So that's like my unfortunate part.
That's a good way to put it. That's like if the FDIC had $1 million. Not a million, but like $1 billion or something.
Yeah, it's like it doesn't matter. It's like, that's just like that's for a show we have it. It's not real. Yeah.
Okay, so I guess, what do you think about the yields then regarding sustainability? Do you think that these yields are sustainable? Will they ever normalize? Because anyone who sees, okay, normally if you see an extremely high yield, okay,
single side staking too.
You start to ask, okay, what's the risk associated with this? Now, they do a good job at kind of making it seem like, hey, we've eliminated that risk by basically employing a delta neutral position, so we're nothing like Terra Luna, right? So I'm just curious about the yield. How can you sustain? So we saw 143% on synthetics. What do we see on here? 33%,
53,
53, and some 55%. So I know it fluctuates, but how would they be able to sustain such a high yield for so long?
So most of their documentation actually has like a 5 to 10% yield. So I give them the props. Like historically, this should be about, if they're going to take their cut, it should be about a 5 to 10% yield. It needs to be higher than wrap take ETH though. So it needs to be about 8 to 10 to be worth.
Are these like anomalous times or what?
Yeah, these are definitely anomalous times. Like, I don't expect this to be here for, I expect this to be here for most of the bull market or whatever we're in right now. But once the bull market dies down, or we don't see these huge volatile swings, the funding rate should go back down to a more reasonable 10 to 15% for this token or like collateralized position. So you should be earning 10 to 15%. Like if you look at historical cool, if you look at what's been happening over the past few years, it's going to be lower at some point. There's just like not sustainable to have this many traders for longer than a bull market, basically. So
why is marketing? This may be a more philosophical question, but like, why is marketing in DeFi always based on the highest fucking yield? Why isn't it not like earn a sustainable, safe yield at even, bro? If I saw 7%, that seems conservative now. It's like we're getting to the point again where we're seeing so many high yield generating platforms everywhere we turn. Everywhere we turn.
Well, this one is an inefficiency in the market, or maybe it's not inefficiency.
This one is different because of the arbitrage. So you're right; it's taking advantage of the inefficiencies, which also begs the question: how sustainable is relying on arbitrage on all parts of your systems at all times? Excluding traders, I just mean as the protocol itself.
For the short term, it's fine. For long term, I actually do worry because I mean, like, there's been some interesting discussion I have with friends about if they get big, like Ethena. There's another one called Stream Finance. There's probably a couple more that are pop up now. If they get big, say they have 1 to 2 billion, 3 billion, 4 billion, 5 billion in assets that will always be putting on this trade. You start to, one, dilute your opportunity cost, so you dilute your actual yield, and then two, you can move the market. Like you have to actually be very, like, it was a problem Yearn had back in the day when they had like 3-4 billion, sorry, in TVL last bull. They had to like figure out how to. They couldn't just throw that into a new yield farm or like some old yield farm, because it would just dilute their yield down to nothing basically. And so you get the same point with these guys where they're going to have to figure out, like, we have to rotate through all the different exchanges, and we're still going to start to destroy our yield, or switch the supply and demand on that funding rate on some of these exchanges too. So it's like they can only get so big at the current state of crypto also.
Yeah, I like the project a lot. And I don't want to seem like I'm talking bad about them, but it's almost like they're just wanting to seize the moment because they know this isn't sustainable. But hey, it may be a lot of people who think that way. You never know. But either way, they are providing an opportunity for traders to capture at the moment. So you can't really say anything bad about it, really.
I ain't touching it.
Yeah.
Right now.
You know that. I'm touching another one. I'm messing with Stream Finance. It's like they think, I think they do 20%. They just say flat 20% on their they're about to change in revariance and stuff, but
they
similar strategy.
They did what I said to an extreme. That's horrible.
They just did flat rates on these. These are variable rates though, and like I'm basically benchmarking myself versus like Ethena and Stream, a Stream protocol here, to see, like, I'm running the trade myself. Can I beat it? If you do it in ETH terms, it's actually much harder than I realized, even though I'm putting the trade on with ETH. But if you do like USDC, because you get paid, the funding rate gets paid out in USDC. That's another thing why everyone loves this. It's because the funding rate is paid out usually in a stable token. So you're getting USDC back, or USDT, or whatever it is that you trade. So it's super cool for people that like to know things in US dollars in their head.
If I remember correctly, you can deposit in USDC, or does it have to be staked ETH?
No, you can for Ethena or in general. You can. Well, for
I forgot this is another platform. My bad.
Oh no, that's all good. This is all good. But I'll go back to Ethena because that's what we're talking about this whole time. For Ethena, you have to buy it unless you have this lovely early access code, which I have not been able to procure. You have to just buy their SUSDE token, and that's how you get access to it. Yeah, you just buy it, and then you're in. You've switched your 1-to-1 ratio, and you stake it, and then you start getting a yield at that point.
Is that their own DEX?
Is that their own DEX? I think that's their own. Yeah, that's their own. I don't know, actually. I don't think they made their own DEX. I don't think so.
Because with how this project is growing, one opportunity I would see is like providing liquidity for like USDC, like the trade that you were just showing, like USDT for USD, what is that, USD?
Oh, this is yeah, USD. Sorry, I was
like,
saying the wrong one. USD.
There's been times where you can get into like a Uniswap V3 position on USDC, USDT, and make it extremely narrow and get sometimes 40% APR on a stable coin. So that's what I was asking, like what DEX that is, because that with all the volume, I'm sure if it was an opportunity, if you're able to, you can get some good yield, and it almost be like single site staking because it's just two stable coins. But if it's their DEX, you probably got to be one of their market makers. It sounds like.
I think it's not on Uniswap. Look, my quick search on Uniswap, it's not on Uniswap. I'd be interested. I haven't actually bought any, so I would be curious. I would check that out. Also, I forgot, and right now is probably the most annoying time again to enter this trade because it's on mainnet. So all these long short strats like this, these carry trades, are always on mainnet. I don't know why they're doing that, but it's the most expensive and eats in so much of your yield because you're like at a loss until you make it back over the course of time. So the TDL they have is ultra sticky right now because it's going to take them so long to make back all their gas fees.
Didn't we move to proof of stake? God damn it, because it's just like.
Yeah, it's even funny. Even like Optimism and Arbitrum, they're Optimism about to have a huge upgrade to reduce their price of fees. But everything's not back. It's like $1, $2. It's not like insane, but it's like, oh wow, this is more expensive than 1 cent it was for like the past 2 years to make an exchange or any trade, any movement of money. But yeah, that's actually interesting. Yeah, because you play on Uniswap way more than I do these days. I think you're like on. I used to trade GM. I think I told you. So I used to trade GMX ETH pools back in the day, and it was very volatile. It was very fun. Made some money, lost some money.
GMX ETH. Oh my god, that thing printed for months in the bear market.
Yes, it did.
Oh man,
I had a friend who made his salary. Yeah, he yeeted into it and he got a good range for about 2 months, and he made a lot of money. I think he made more than his salary during that time, so it was a good time.
Wow.
Yeah,
and we're in the golden ages of yield farming when a lot of people don't really know about market making yet.
Yeah, I mean, well, it's hard. As we divert to the Uniswap stuff, it's really hard to keep your edge, in my opinion, on that. Like I think it's equal to or more work than this carry trade is, because you do have to manage your stuff with the carry trade, but like you have to be much more in the know of like what's going on with said project, what's going on with said like market, and then if you want to make the real money quickly, you have to be pretty tight because you got to be paying attention to it every day because you don't want to get liquidated. Or at least I didn't want to lose my position and get out of range. So,
man, have you heard of Aperture Finance?
No, I haven't heard of Aperture.
Oh, bro, you got to check out Aperture. They allow you to, it's almost, so you have Gamma, which is like a full vault, and they do everything for you, but they take a fee. Aperture, they rate PC, so it's no fees to use it. So they have like their rebalancing feature where instead of having to pay multiple gas fees, where you have to withdraw, pay a gas fees, do that fucking math to figure out like, if it's not 50, this is how much said asset A and said asset B I need to have. They do that for you, and they do it all in one transaction. But the cool thing is they have these triggers where you can say, if price goes out of range, re-enter me into this range. And then also they're working on the team is out here. So I've had lunch with a couple of guys. They're going to have a feature to where they're calling it perpetual rebalancing. So that way you can almost like always stay within range, and that you only pay gas fees.
Have they back tested that? Because I knew there was it wasn't either of the two you mentioned earlier, but it was like an issue where if you keep rebalancing, you start to eat into your yield due to, I'm assuming you're doing like a WETH something pair, like a WETH token pair.
All of mine are paired with ETH, yeah.
Okay, maybe I haven't messed with this in a long time, but there was an issue with like you rebalance too much, IL starts to eat into you because you're getting a ton of it if you're having to rebalance.
You might have seen some of these videos, but I think about yield farming a little different. I don't worry about IL too much. Just because like I use 20% of my 20 to 25% of my portfolio for yield farming. And it's like, if you think about it, like in a reverse engineered way, it has to be what the market makers do, because they don't yield farm with their whole portfolio. They yield farm they have cash and they have assets on their balance sheet. So what I try to do is I set like an intelligent range, and I'll have tranches. Like right now I'm in some maple pools where I'm in a maple, but I'm also in like a narrow one, significantly less capital, but the rewards are the same. I take the rewards, I'll take my ETH and I'll use it to buy more Maple, and I'll just keep doing that. And like I've gotten to the point where I'm yield farming with house money, and when I go and rebalance my portfolio on a monthly basis, the 20%, the 20% that I'm using for yield farming represents a larger portion. So I just kind of pair it up. I'm not trying to like. I feel like when you try to well, you're looking at it as like like the end all be all instead of just looking at it as a tool. I'm just trying to accumulate assets, and then once those assets that I accumulate pump, I take profits, and then I rebalance, and then that has to be.
I get it now. I get it now. So like I'm gonna say things back. So like you're basically entering into whatever Uniswap position, and you have 1 to 2 or 3. That's up to you how many you want to have. But the big thing is you're reinvesting into your positions until you get to like I'm not gonna say until you get to house money, where it's like you either made back the same amount or you have like it got into the percent where it's now allocating 20%. I can remove, sell, whatever happens, whether it be pumps or whatever. So you're actively looking for tokens that are at value or lightly undervalued, and then you're also reinvesting, which is the big thing that not everyone does with those fees. Because if you reinvest, IL starts to become negligent over time because you've increased your position significantly.
I reinvest into my hodls. I don't compound back into the pool because then.
Oh, okay.
Yeah, and the reason why is because like that's when bro, for example, like the Maple ETH pool, like right now I'm getting like 200%. It fluctuates between like 100 to 300, the wide one.
Not bad.
So it's like, let's say I get that for 6 months and I start off with a 12K principal. So I get 50%. Now I just accumulated an extra $6,000 in Maple for free. And I put that in my hodl bag. So now when Maple pumps, I actually get to experience all of that price appreciation. I'm not capped at the top of my range. So I can turn that 6K into 6 figures. If Maple, I think it's going to do. So then I'm able to take profits, I rebalance, and now what was 12K could actually be like 50, 60, 70K, and I'm just keep doing that over and over and over again.
Like most market makers, their focus would be on the profitability of that pool or that position versus saying in accumulation, basically. And so by accumulation, it's like it literally would contradict yourself if you were to focus on impermanent loss.
Yeah, because if I constantly compound back into the pool, eventually the shit's gonna go out of range and I don't get to actually benefit for what I accumulated. But if I'm taking those and I'm, adding them to my hodl wallet or my hodl bag, whatever you want to call it, that's how, in my opinion, that's how I win.
Yeah, because one of the things I get I get scared about more so now is like we're all looking at different protocols, but entering into Uniswap, if they're on Uniswap or mainnet, mainly mainnet, but if they're on Uniswap and you want to enter into a concentrated liquidity position, I'm like, there's so much opportunity cost because I'm like not as deep as I was in 2020 where I was like researching aggressively all these things and like seeing if they're sustainable or not, or if they're gonna have it going in the right direction. So like you have Maple, which Maple is a great product, great protocol, actually really good team too. And you're like, okay, I want to have more of this. Even if it doesn't pop, just the fact you have a 6K, whatever, it doesn't matter what the number. You created a position that is in your hodl bag, or just like you don't have to worry if you're not trying to earn yield on it. It's just there. And if it does pop, awesome. But you're taking multiple bets on it at that point. So you're like, you have hopefully 4 or 5 of those Maples. Like you probably did the same thing with Pendle or something similar with Pendle.
I'm doing it with Pendle, I'm doing it with Maple, I'm doing it with Clearpool.
Okay. Combining the way Warren Buffett invested in terms of value investing, because you're going after certain projects that have that fundamental value, but it's just not realized. But obviously, you got degen shit in terms of DeFi market making.
And then here's another thing that I haven't heard anyone talk about on the internet. Like we always talk about like selling shovels. People who made most of the money during the gold rush are the people who sold shovels. And it's just like, I actually made a video on this too. If you market make for projects, like before they pump, like for example, the Maple ETH pool is like it's not even $1 million TVL, right? So it's like that's what I'm saying. It's crazy, but it's a solid project. But the TVL is extremely low. So it's like once people wake up to Maple and they start to like buy it by the troves, you know how it is on Coinbase. In bull markets, shit fucks up. It just happened the other day. Trading got halted. My friends texted me like, "Man, what's up with Coinbase?" I'm like, "It's a bull market." So it's like who can't immediately get set up on Coinbase, they go on MetaMask, right? So they're buying the Maple on the decentralized exchanges. So the few people who are in that small TVO pool, it's like selling shovels during the gold rush when you're the only shovel shop in town, because the volume is going to be so, like the volume to TVO ratio on Maple on the 24-hour for the, as long as I've been in it, like the other day, 12K principal, I had like $900 in rewards. 2 days later, over $2,000 in rewards. So it's like, I try to get ahead of the volume when I'm providing liquidity, when I know, when I'm trying to anticipate, like I know people are going to come in this pool and start buying it. And then you have an opportunity to earn like quadruple digit yields for a short period of time.
Yeah, that's I mean, that's fine. It's still like you were there when it happened, and you're not trying to catch the dragon, rather than you're already there for the the moment. So
Exactly.
Yeah.
And then the last thing is like, it went out of range. Once ETH did that fucking crazy pump, Maple actually dropped at the same time. This is when, like, most of my strategies, I want to get as much in permanent loss as I can, because when that happened, I sold all of my ETH rewards for Maple, and then Maple pumped, and I took a little bit of profits, and now I just rinse and repeat. So it's like I want my range because it helps me. Like, no one talks about all this stuff though.
Yeah, it's hard to, like, I don't even know how you would like codify that to make it like repeatable. I mean, it is pretty repeatable, because I'm like thinking of what you just did. I was like, that happens to premium. When ETH pumps, premium goes down, you buy more. If you want to do, you buy more premium. Premium usually comes back to at least where it was at before, or close to it. So I'm like, I'm aware this happens because it's market makers playing market maker games, or like bots playing bot games somewhere, trying to keep that ratio for that they have, whatever the token is. It's just like hard to explain that to people unless you see it. Like, I mean, I guess if you look at the I'm like thinking about that, because it's also scary to do. You've gotten over the fear of like it's gonna go to zero. That's the biggest thing too, because everyone doesn't want to lose.
Principle of this is like volatility. So if you could learn how to monitor volatility, that like instills some confidence in the person, whoever it is, and then everything else just kind of falls into play. I feel like if you could just start at volatility, because then that'll determine, obviously, all right, okay, I know this is a volatile period. I know I might go out of range here. You could set that plan up for when you go out of range to the upside on something like an ETH. So if you could monitor volatility, I think this is just a thought because I just thought of it right now. But yeah, I feel like that'd be a good first spot to start at for anyone who's interested in actually being a market maker.
Yeah, the fun thing about what you're saying is like you could monitoring volatility on ETH BTC. There's many things that tell you that what the volatility, like the skew is, but on the altcoins there's like nothing. Like that's one of the reasons I was not hesitant about premium, but it's just like we're trying very aggressively to figure out how to effectively get volatility, or like no volatility on some of these shit tokens. Like it can be like optimism arbitrum. Like it's hard to predict that because one, they've not been around long enough. Two, they can be moved very easily. On the overall, they can be moved very easily compared to ETH and Bitcoin, and they're not as old. And then you go to like things like Maple. It's like you said there's like under $1 million in their liquidity pools. It's like that's how do you predict all these things going on? But if you can find it, get a good read on it, whether it be
I think a simple answer to that, because there's no fucking way to do it, but like if you understand Bitcoin volatility, or could determine which direction you believe that's going to go in, the gravitational pull is still pretty heavy. And most of the time, if you could guess Bitcoin correct, most of the time you're going to be correct on an altcoin. But obviously you got some ones that are negatively correlated at any given point in time as well. But
I would actually say you don't need to guess if it's going up or down. You just need to guess it's volatile. Like if the moment is volatile, like that's the easier. Most people can do that. Like you have a good prediction of that.
To the upside, that's what mainly matters, because the whole point is
downside too. Actually helps.
Yeah, I mean you could prep for downside or upside in my head.
Yeah,
say that one more time.
You could so what he's saying is like I would say you can predict within like pretty good reason when there's going to be a volatile moment. Like ETH and BTC were trading at the lowest volatility ever for I think 10 vol as of for most of last year. Like people were scared because it was so low, because usually when you have a super low volatility moment, there's going to be a spike at some point. Like it's not sustainable to be able to sell calls or puts at these super cheap prices for a long period of time and then not have someone lose at that point, like not have the sellers lose. So like we're watching it at 10 vol. I think it even dropped to like 5 vol, which is like no volatility.
That is pretty great.
Yeah, and so you don't even care if it's go. You just know something is going to go up or down. You don't know what, but you're like, this is not sustainable because these prices are too good for people taking them long for this amount of time. And someone's going to start actually like buying into the spot positions. And so it took us a year, but we see this violent upswing, but we were seeing like the foreshadowing like that was a year out basically for on volatility side. We didn't know which way it was going to go, but you knew that there was going to be volatility coming in the near future. Near future could be a year, it could be 2 years. Not sure on the time horizon of people, but you can predict it pretty well now with BTC and ETH as your like, I guess your alpha, your beta indicators. I don't know what we call them, but yeah.
No, yeah.
I'd be very, very intrigued though, because like you guys could set this up. I wouldn't even know how to set up a short position on Uniswap. Like I wouldn't know how to get like prepare for the downside, but like it would. You can make money on both. I know that as you're saying.
I just provide range and give it room to go down, and then you can use arbitrum. Like imagine like the flash crash we just had the other day when Bitcoin, or I think yesterday, when Bitcoin was 8, 9, 10K. Appetite Finance allows you to say, hey, if this price trigger hits, take me out of the market. So you can provide liquidity. Like if price is here, you provide liquidity from here to here. And as soon as it hits your price range, you get taken out with your principal plus fees. And now when Bitcoin goes right back up, you make money. So that's going to be my bear market strategy. Just giving it more room in the downside. Like right now, we're in a bull market, so I'm giving it room to run because I want to be taking profits in ETH. So
I'm surprised. It's similar note, different note than Uniswap, but I'm surprised your Maple has not started running. I don't know how much TVL they have or whatever, but it's fun seeing the projects that have made it through this bear market getting some love on the alts. Like the top, I guess 200, 300 tokens have been like killing it. Which premium is included in that? But Maple, I know a couple of at least one investor, like one VC that backed them a while ago. And he's just happy that they're alive, and like he's like just waiting, silently waiting for this is gonna be a really good moment for them soon. I think.
Funny, this whole time I was thinking, like, damn, I genuinely still don't know like what this topic of this video was.
It's gone everywhere now. So we started on carry trades and Ethena, and now we're talking about yield farming strategies. You know, it's a little hodgepodge. And next time I will hopefully be ready. Give me a couple more weeks, but I'll hopefully be ready to talk to you about Uniswap options, basically using Uniswap for options. I've been lightly diving. If you want someone who knows how to do it for real, I'll see if you will. We'll talk to you guys. But
yeah, man, when you're ready, I would love to have make a video on doing stuff like that. Well, guys, that was a great conversation. Chris, we appreciate you for coming on, man. From the motherland.
I literally was about to say this.
Yep. So guys, if you got value from this video, we ask that you drop a comment, drop a like, subscribe, let us know what project or strategy you want us to cover next. Let us know what you want Chris to come back on and cover. But other than that, we thank you guys for watching, and we'll see you on the next one.
See you on the next. Thanks, guys. Peace.